Good afternoon. I'm really pleased that you could join us today for the first ever Future Worlds online event. For those of you who don't know, Future Worlds is the on-campus startup accelerator at the University of Southampton. So we exist to help aspiring startup founders to change the world with their ideas. And every year we see a stream of phenomenally talented startup founders bring their ideas to us and look to turn them into something bigger than they could have imagined. And it's so exciting to see that happen. And often it happens when we put them together with some of the incredible mentors and investors and advisors in our network who can bring their skills and their knowledge to really transform the prospects of those startups. And we've seen it work time and time again. And so we thought it'd be a great opportunity now to bring some of those people together in this panel interview so that they could share their experience with all of you. And so what are you going to learn today by being part of this call? Well, you're going to learn what is it that investors are looking for? What does it really take to raise seed investment? What do you need to do as a founder? What are some of the common mistakes that you might make? And then if you are successful, what should you be looking for as a founder in your potential investors? You need to test them and find out whether they're right. So you're going to have some help on that as well. And then we're also going to be thinking about what's the impact of the current COVID crisis on the prospects of raising investment and what can startups do to respond to that. So there's loads of things to learn. I hope you really enjoy it. This has been a pre-recorded panel event, and so the panelists aren't live, but the Future Worlds team is live now. So please do use the chat function, ask any questions, and we'll get back to you as quickly as we can. And lastly, if you've not already signed up to receive our newsletter, make sure you sign up here and you'll hear about all of the events that we've got to come. Thanks a lot. Enjoy the event. Okay, so welcome everyone to the first Future Worlds online event, which is about pitching for seed investment, the good, the bad and the ugly. And as an online event, we're really lucky that we've got three fantastic panelists. And it's great because we can pull people from across the world as an online event. So today we're coming from Southampton, from London and from San Francisco. And we're going to be really trying to delve into what is it as a founder you need to do to raise seed investment through a pitch, and what works well, what doesn't work so well. But before any further delay, I'm keen to hand over to our panel. So if I could ask you each to introduce yourselves. Perhaps Ali first.
Great. So I think we're all waiting on each other as we learn in these video conferencing times. So my name's Alistair, or everyone calls me Ali Mitchell. I'm an alumni of Southampton Ship Science, 96 to 2000. So it's great to be talking to you guys. I am, as we said, currently based in San Francisco, where I've been for about 8 years. I'm a founder, tech founder turned to the dark side as a VC investor. All I've done since leaving university and doing my first startup with Ship Science alumni back in 2000, and then 5 of those through the ups and the downs. Moved to the Bay Area about 8 years ago with my last startup, which we sold before I joined to become an investor at EQT Ventures, which is a Swedish European US fund, where I'm now the managing partner. And we invest from seed all the way up to late seed, I should say, all the way up to Series C, purely in tech, software, B2B and B2C. And it's great to be talking to you guys.
Fantastic. Thanks, Ali. Max, maybe you could go next.
Great to be speaking to you. I'm Max. My parents live near Southampton, which is how I'm involved in this. I know and love the place. My background, I worked at Virgin Group for 12 years. My job was starting up new companies there. I started up 4 different companies, co-founded another one outside that. And off the side of my desk, I was also doing the strategy for the group, which was a great kind of roller coaster from kind of 4 billion of revenue up to 20 billion of revenue. Once I completed kind of my time at Virgin, I ended up going to Techstars, which is an accelerator. I ran Techstars London for 3 years, and then took on the global strategy role there. So, where Techstars should be going, what kind of offerings it should have in the market and so on. So that's me.
Fantastic. Thanks, Max. And lastly, Sonja.
I'm Sonja Lami. I live in London and I work in asset management at the moment as a fund manager for an internal absolute return fund of funds. I'm also in the investment committee at Insight for various absolute return products. But in my spare time, I do angel investing, which I've done for around 8 years. And I've seen lots of companies and I've done a few investments. And I love to see these companies grow over time.
Fantastic. Thanks, Sonja. And what Sonja hasn't mentioned, which is relevant, a lot of the people in the audience for this event are the aspiring founders at Southampton who go to the Future Worlds Dragon's Den event. And we've got 12 in a cohort going through to this year's event. And Sonja has been one of the dragons in the last 2 Future Worlds events. So if you're looking to pitch into Dragon's Den, you definitely want to hear what turns Sonja onto a great investment opportunity. So we're really looking forward to hearing what you've all got to say this evening. So we're talking about pitching. We're talking about pitching for investment. It's you never pitch in a vacuum, obviously. And at the moment, we're in the midst of a huge global economic crisis that is obviously going to have a huge impact on investing and what that's going to look like over the months and the years ahead. So we could spend all of our time talking about that, and we will come back to it. We'll give it a bit of time. Spoiler alert: I'm an optimist who always believes in the potential of fantastically talented founders to really shape and build the world of tomorrow. And I believe that in times of crisis and disruption, there is never a better opportunity as a startup founder to then create a niche. But that's my perspective. We'll come back to that. But what I'm keen to do to start with is focus on the pitch itself. In Future Worlds, we do a house style. We get people ready for pitching to dragons like Sonja, and we go through a standard structure like problem, solution, traction, team, market, and the ask, which is fine. It gives people a framework. But of course, a pitch is far more than just the content. A pitch goes beyond just that. And so, Max, you've seen thousands of startup pitches. What is it for you that really makes for a successful startup pitch?
I think the key piece is not the pitch itself. The reality is it's a relationship that you need to build over time, and that relationship needs to flourish, really. And so if you go into a meeting, don't expect anyone to write you a check until you're several meetings into that journey. So the first thing you need to think about is how you're going to contact those people and who you should be contacting. So depending on the stage you're at, if we're talking about seed, it's probably going to be angels and maybe micro VCs. You want to have a target list of those people. You want to get warm introductions to them. You must know someone who knows them, which allows you to connect to them. You can get connected to them direct, but that tends to be it's called a cold intro, cold email. That's really tough. The people have got no concept, and therefore it's really difficult for them to take you seriously. So that's the first stage, is to actually get an initial meeting. Normally those initial meetings, they're often couched as advice rather than any kind of ask for money, because it's the start of a relationship. You're playing to some extent to ego. And so you're saying, look, I'd love to have a chat. I'd love to get your advice on, how my business is going, and see where you think we could be pushing forward. So that's the first stage. It may well be a coffee or a Zoom meeting in these strange times. Over time, at a certain point, you will then need to pitch, and that pitch is really very standard. So Sequoia, one of the leading VC firms in the world, has published a standard view of that. There was a DocSend who are a company that does documents that's kind of sent out to VCs. They analyzed 200 pitches, and they're all very, very similar. And they follow pretty much what Ben just said, which is a view of the company, an overview of the company, a short overview at the front, then really diving into what the problem and the solution is, normally some sort of demo, why now is an important thing, the market and competition, some details around the product, the business model and the go-to-market, team, and at the end then the financials, and we can talk more if you like about the financials, but they tend to be very light at the stage that we're talking about here, which is really early in the journey. So that's the pitch structure. You'll normally have a beautiful deck that goes with that. You'll often in the meeting not actually refer to the deck, or maybe flick to 1 or 2 slides. It depends how formal it is. As you get into the later stages of those discussions, you may do something a bit more formal, but it's really about establishing and building a relationship over time.
And so, Sonja, you have done multiple angel investments. You've also sat on the Future World stage and then been asked to consider investments where you've got no relationship, no background, and you've just got a 5-minute pitch on a stage. What is it that stands out for you in the ones that you've made offers to?
For me, it's important to know exactly who your target audience is. And by target audience, I mean your client, and in specific, the paying customer. So something, for example, if you're designing something for children, yes, they're the target audience, but ultimately your paying customers would be their parents. So for me, outlining that clearly is important. It's also important just to like the person, because when you do a pitch, as Max said, of course, the content is one thing, but it's also that relationship. And do you think this person is going to be resilient if things don't go their way? Are they so set in their ways that if you ask them a slightly curveball question or a what if question, they say, no, that's not possible. They're so set on it will go according to plan because their plan is perfect. Or are they able to say, actually, were that to happen, I think I'll do the following. So there's little questions you can ask just to sort of test the personality and to see how someone might react in different types of pressure situations. So for me in a pitch, I know there's a standard order of the pitch, the problem, the solution, all that, but you can almost narrow it down sort of 4 T's, like the team, the tech, and by the tech, it's either the actual product or the service, whatever they're providing, the traction they've had since forming the idea to wherever they are right now, and then also the target audience. And again, this target audience, something I'm focus on quite a lot, because I think when people are too wide in who they target, they end up not building something that suits anybody. And then for me also, which I often find missing in pitches, would be the revenue model. So they come up with all these ideas, but they don't clearly delineate how am I going to charge for this and who's actually going to pay for it.
Cool. Really, really helpful. So you kind of got a relationship, you've got the model side, and then the person and what comes across. What about you, Ali? What do you see from your side?
I think I think everything that's been said is absolutely right. I would emphasize it's the who, right? Especially in the early stages. When you're pitching, when you've got nothing really more than an idea and maybe a working prototype and an idea of what your market is, the first thing that an investor's looking for, and frankly, this is the same at Series A and B and C and D and E through to IPO. It's all about the founder and the founding team and who. So that personal connection is super important. The trust that you build over several meetings, as Max said, and so you emphasizing why you, like why are you uniquely positioned to do this? What have you done that shows that you can do this? And then when it comes to building relationship, like why is there a connection between you and the possible angel, and why are they backing you? There's normally angels are backing you as a person. There's nothing there, right? There's no product really, so all they've got is to back you. So there's normally a personal connection. And then why you in relation to this problem? Why are you uniquely positioned to do this? And why is this problem going to be big? And one obvious mistake we often see there is people running away from competition, saying, "Oh, it's a new space, no one's done this before." Actually, that can often be the worst sign. There's nothing worse than being in a market where no one else is in that market. That means it isn't a market. So pointing out other people who have done this, other great startups that are tackling this, other people who have raised loads of money, but why you're doing something different and why you is a big one. I mean, just a good example of what this is, just to give a story from our founding. This is a long time ago now, from our last company, 10 years ago, when we founded Huddle in the UK, and we were looking for our first angel investor, and this speaks to all the things that Max and Sonja were saying, but we were looking for someone to lead the investment as an angel. My co-founder just left a company that was founded down in the southeast, south of England in Basingstoke, and the founder there, who was a successful angel, had just left, had a lot of money, and we said this would be the ideal person. It's in collaboration, a similar space. This guy was in telecoms. He just exited. He's got loads of money. There's some trust there because Andy used to work for him. So Andy got hold of his EA and he said, I can get you 5 minutes when he's driving between his home and his office in his Aston for you to do a pitch, right, over 5 minutes. And all you need to do is we just want to get a meeting to do then the full pitch and get to restart the relationship, because it's been a while since Andy had worked for this guy. And Andy did it. He pitched him and gave him the 3-minute, literally the elevator pitch. There was trust there because he'd worked for him, and this guy had always recognized Andy and the entrepreneurial talent he had. It was timing because he had money and understood that the problem we were solving was one that he'd recognized in the market, and he had time. And so he was looking to start doing some more angel investing. So all of those things come together, and if it matches up on the angel side and it matches up on your side, then that's when you get a fit and these deals happen. I just say probably 2 other things just to finish off on this. I mean, the other one, in addition to what people have said, is the bar is very high now, right? You can start startups and build tech faster and with less money than anyone before. And the days of just an idea on a slide are gone, right? Most people will expect something to be built or some traction, some proof point. And so that's why technologists, developers are in such hot demand, because you can build stuff out of nothing and actually prove that there is something there. And then the second thing is Sequoia is a great one to follow, as Max said. The other great ones to follow are Y Combinator, YC, who are the preeminent accelerator out in the Valley. And what they focus on, and not just their good advice on pitching, but also is this idea of thin slicing. Focus on one simple problem and solve it better than anyone else, with a unique angle that no one else can do, and execute it better, rather than, to what Sonja was saying, as she said, trying to solve too big a problem, trying to do too much. That great vision, that's where you want to go. That's the billion-dollar, billion-pound business. But you start it by starting your first 1 million, then your first 10 million, then your first 20, then your first 50, then your first 100 million, and then you go from there. But if you don't get to your first million, you're not got anything. So it's that idea of thin slicing to solve your way to a bigger problem.
And I guess in some ways it's almost the flip side of the argument, the kind of what stands out, what looks really good, and you've answered it on the positive side. Looking to you, Sonja, what would be some of the common mistakes that you see founders falling into that then trip them up, that then turn you off?
Okay, so one is, if whether it's a pitch or an informal chat, if you have to speak longer than 1 minute or hear a pitch for longer than 1 minute before you actually know what they're selling you. So just cut to the chase, give the 30-second elevator pitch up front, and then you've got my interest and we go into more detail. And the other one that I keep somehow seeing in presentations is on the team chart, when people just put their first names. And the team is like the most important part of an early stage startup. So your name and your surname, please. For example, it's just an easy one to fix, but it's amazing how you still see that happening in early stage companies.
What about Ali, Max, either of you?
Max, you go. I spoke for long enough last time.
Yeah, I think two of the points that I'd reiterate two of the points. One is the revenue model. You need to make sure that the revenues, normally you'll put 3 years of revenue in. You need to explain what the drivers of the revenue are, but it needs to be interesting enough for someone to invest. So, if it's 100,000 revenue after 3 years, it's not going to be interesting. If it's 500 million, it's going to be pretty implausible. So how are you justifying from the bottom up, really, the pricing, the number of customers you can get, and however you're driving your revenue. The other one is the one I really don't like is I've got no competition, which Ali said. You have, and if you haven't, that's magic, because whatever the need is that the customer has, they must be stating that need in some way, even if it's a very artificial and uncomfortable solution at the moment. So never say that you don't have competition, even if the competition is some weird workaround that the customers that you're targeting have. Explain that, but don't say you haven't got any. Those are two, and just to reiterate again, exactly the other thing as well. It's the team. It's the team. Well, at Techstars we say team, market traction idea, and so idea is the bottom of the pile. People often lead with that. It's really so important about how exceptional the team are, because it's that makes or breaks a company.
And totally, I think if there's one message that's coming through, it's that, right? And then just to pick up on your point about the revenue model, I think you also see examples of incredibly detailed spreadsheets, right? When this is a startup at the start of a journey, you have no idea. I mean, there's that old phrase, no plan survives first contact with the enemy, or until plan is only a plan until you get smacked in the face. I mean, your plan will be redundant on the second day after you've written the plan in a startup, probably the second hour after you've written the plan. I think the point is to show that, as Max was saying, that there is a big market for this, and that you can capture it with this model, and that it's feasible that you can grow into it over this time period. But and that you can serve it in some way of cost that doesn't mean you're going to be losing money to be able to acquire those customers or users or whatever it is. But having the nth degree is going to be just implausible. It shows you've thought about it, and that's great, but it's not going to be real, right? And no investor will look at it and go, oh, that's going to be your plan. And if they do, then they're never going to be a terrible angel for you. But you do need to just show the core elements, which is, can it be very big? Can you acquire the customers, users at for less than they're going to make over time? And you might not even know how you're going to monetize it, but at least some idea of how you might get there, right? And I think those are the key elements. And this then goes on to, perhaps one interesting topic that you might see is why are you getting angel investment in the first place, or any form of seed investment in the first place? Because I think the thing to be aware of is that if you're going to get high quality angels or seed investors and microfund, especially if you're going off something like Techstars, you're at the start of a journey, and there is only one path on that journey, which is why you're starting it, which is you're going to raise another round, and then another round, and another round. And that's not for the benefit of the investors. It's because most big businesses, there are a few exceptions, but most big businesses, big tech companies, need to raise a lot of money over their lifestyle to grow and build a very big tech business. That's why investors exist, right? If you're going to do this because you want to raise a bit of money and then you think you'll retreat back to a shed and just have two of you and make a nice lifestyle business making a couple $100,000 a year, it is unlikely you're going to get a series of angel investors interested in you. So don't be scared of that journey. That is the journey. And it's why angel investors, because they're not going to make money for 10 years. They want to know that there's another investor coming in to help you grow. If you want to go out and expand, build new products, hire a dev team, hire a sales team, that all takes money, probably ahead of where you're making your revenues. So just be aware that's the journey you're going on, and understand that's the game you're getting into. If you want to go on that journey, and it's not right for everyone. But
I often say, if you can avoid taking money, then do, because the sweetest type of money is client money, where they're paying you to build your business and validate all of your assumptions of your business model. So if you can avoid taking money and you can do all the sums, it's actually really attractive. If you can build a mid-sized company, you'll probably walk away with more money than if you create a massive business but got massively diluted. And also you'll have had control and therefore probably more fun on the way through. So I often will advise, if you can avoid that treadmill, because once you're on it, you can't get off it.
Absolutely.
And that's an interesting one. It kind of poses one of the questions that one of the founders coming through the Dragon's Den co at the moment asked was exactly that. What are the pros and cons between going for equity early or trying to bootstrap for longer? How do you, in a sense, you've articulated the pro of the bootstrap route, Max. What's the pro of the equity early? Is there one, or should you?
I totally agree with Matt. So when the best businesses often do both, right? I mean, you can, especially in the early stages, if you can get it, but not all businesses can, right? B2C businesses, consumer businesses. If you're building a big bit of fundamental DevOps tech, where actually you need lots of users to do it. So it depends on your business model. It depends on what sort of business you're doing. It depends on what sort of founder you want to be and what you want to do. But it's just being aware of what the journey you're on, right? As you said, it's a treadmill, right? That it's not a one and done, right? You don't go and raise a little bit of money or get another investor and then expect that's it going to be forever, right? It's the start of a journey. If you are trying to, there are certain type of business where it is almost impossible to build that type of business without raising some form of outside capital of some form. Not all businesses, but some, especially those that require a big infrastructure investment or B2C. But the common thing they'll all have, whether they've been client funded or you raise some money or whatever, or you use your own funding, is that they people have validated them and got some proof and traction and proof points before they've gone and raised the money, whatever that is. If you're customers, that's your proof, right? You've sold it to a customer, great. But if you haven't got customers, you've at least built a prototype, built an app, proved the market, got something, got some early users, proved something that you can then prove this is real. And then if the market's real, and you're a great founder and you've got some initial proof point of some form, then those three, and then you get a personal connection with someone, then that's how the magic kind of happens.
Sure.
Yeah.
And that really touches on then what founders should look for in investors. So if you're in the start of that journey and you are starting to reach out to investors, what would you advise founders should look for in their investors? Maybe start with you, Ali, again on that one.
I'll be quick. It's the personal connection again, I think, especially at this stage, right? But you should spend as much time interviewing them as the other way around, because I've seen actually many more businesses break by having to deal with bad investors, bad boards, than actually almost they can kill it even faster than a founder can. And I had that, honestly, in some of my startups. I had a really tough time in a couple of my businesses, and I can tell lots of war stories about that. But that personal connection of someone who understands you and believes in you, and has enough money to be able to let this be and let you get on with it. You see oftentimes where people, this is why friends and family rounds can be dangerous, right? It's great to get friends and family money for the beginning, but they need to know that they might lose all that money and they're never going to see it again, and they're going to let you get on with it. The worst type of angel investors are the ones where they don't necessarily believe in you. They're expecting a financial return in the first year, and they're going to really control every penny and control you. Not because they might be bad, they might have amazing ideas, but that's the whole point of an investor, is to help you and be helpful, but also to let you get on with it, and not to try and be. So it's about that match, it's about the personality fit, but also having honest conversations and the right amount of money that they can risk.
Yeah, and I think if you ever have the luxury as a founder, if you ever have the luxury of choice between investors, and so not quite play them off against each other, but we want someone who's able to help you in some way or the other, ideally. But as everyone was saying, like in the first instance, support you as an individual, someone that you'd actually like to have a beer with, they'd probably like to go out with you. Someone who believes in you more than your idea, but also someone that can ideally help you, whether that's connecting you with potential clients, whether it's helping you with potential future investment rounds by introducing you to their friends or angel friends, and see sort of how that network can support you.
Nice.
And I'd say that you can ask very direct questions.
Yes.
That's fine. Good investors will expect you to. So the sorts of questions that you should ask is what size is the check that you normally write? How many checks have you written in the last 12 months? That's really important to see whether they're actively investing. How many investments have you done overall? Because you want to be part of a journey for that angel. So you don't want to be their first or second, because then they become massively over preoccupied with you, and you really don't need that. And you also want them to understand that they can lose all the money, as Ali just said. So ask them that. The other thing is you can ask for who else they've invested in, and then go and do some reference checks. So you can actually go and say, is this person helpful? And if they're not helpful and they're a terrible pain, then at least you can find out that way. So, and if they're not willing to share that information with you, that should be a red flag. So go ahead and ask questions. It's a two-way relationship, and it lasts a long time. So make sure that you've understood what you're getting into.
Absolutely. If anything, the angel would just, the investor would just respect you more if you have a conversation as a peer and not as just someone who wants your money.
Yeah, absolutely. So look, we've said there's obviously this small matter of a virus going around. We've said that that's going to have a big impact on startups. I guess looking at the three of you, you may all have different perspectives on the impact that that's going to have. And how do you see that affecting the prospects of founders now that have maybe already raised, or founders that are looking at the prospect of raising? How do you see that landscape emerging? So Max, maybe start with you.
So I got a bit overwhelmed by this a few weeks ago, so I thought I'd pull together a story on it. And so I'll just kind of go through that because I'm very bearish, and it's going to be fascinating to see what the other two say. I think it's going to be a really tough time. So the first part is this is the largest contraction we've seen in the last 300 years. The last kind of contraction this large was the South Sea bubble. There's a wave of unemployment that has hit the US, and it's visible in the US. It's the same for Europe. It's just somewhat hidden in Europe because of some of the activity that government is taking. In the US, you're over 20%, and probably quite close now to 25% unemployment. 1 in 4 people unemployed. Just to give some context, in the last 50 years, unemployment has never been above 11%. This is as bad as it was for the Great Depression. Consumer confidence has started to drop, and we're seeing that it's dropped very precipitously, actually. And consumer behavior is expected to worsen. So you're seeing the financial Gallup does a poll on financial prospects for individuals. This is the worst it's been since 2002, and banks are already provisioning for bad debt to come through. It's not likely to come back quickly. You can look, it's amazing. You can look into a crystal ball because you can look at what's happened in the Chinese economy. And if you look there, then consumer discretionary spend just really hasn't come back. So it's about 65% of what it was this time last year. And so it was much worse than that. But the V shape is not a V shape. It's more like a Nike swoosh. The government has stepped in with massive stimulus, whether that's the ECB in Europe, it's the Bank of England here, or whether it's the Fed in the US. massive, unprecedented amounts of money being poured in. That has propped up the stock market to some extent, but how long that lasts, I think when you see Q2 earnings come through, that's going to be really, really tough. And you've seen a series of industries that are just absolutely hammered. So anything leisure-based, travel-based, just absolutely hammered. And you might say, oh, well, it's going to, you know, once everything opens up, all those jobs are going to come back. I just don't think that's going to be the case. So I think unemployment's going to hover between 15 and 20% in the US. Massive social welfare issues, just really, really a tough time. In that context, what that means for startups is investor decisions are going to be very slow. Individuals are going to lost a lot of money in the stock market. They're going to be slower on their decisions and write fewer checks. So that personally, I just think that the whole market is going to slow. It's going to be tough. And yes, we can say that great companies are built, you know, Amazon and Google and Facebook, all of those companies are built in recessions. True, but what you don't, that's a strong survival bias there. All the ones that didn't survive, you've never heard of. So I wouldn't be seduced by that argument either. So for me, bearish.
Is that the same for everyone else? Everyone else a bear on the current prospects?
I do actually agree with a lot of what, I mean, I think it's hard to disagree with a lot of the things that Max said, and it's backed by data and experience. But I'm a bit more like you, Ben. I'm more of an optimistic glass half full. I think you have to be if you're a founder, right? Going through, unbelievably at different odds. I think while I don't disagree with anything you say, I think reasons to be optimistic. Let's leave it like that. Like reasons to be perhaps on the more optimistic side. I think I totally agree about the shape of the economy. I think that the irrational bounce back we've seen in the macro economy it will be short-lived, and it will, after Q2, we'll see another drop down, probably more like a W shape than anything else, probably, or a bath. But you know, there's many different U-shape, bath shape, V-shape, W shape. But if you think about it, we bounce back. I think we will see another drop. I agree with that. And the importance of that on the macro economy, on it, why do you think, well, why does that affect startups? Well, it is, as you said, because you know, angels especially are people who have probably made money in other parts of their careers. Maybe they made money in the stock market, maybe in the city. Maybe they're like you, Sonja, and you know, they're looking at their portfolio and thinking, well, actually, I don't have as much money as I had before. I can't do it as a luxury investing in a startup. That's on the negative side. On the positive side, on the VC side, all the VCs are switching to invest earlier and have huge amounts of dry powder to invest because they all raise their money, a lot of them just before this. The biggest fundraising cycle we had was the last 18 months. And we are all, as a class, all looking, as a genre, all looking at early stage because we know this is a great time to invest because you can invest in great companies now and then you get a natural bull run for the next 10 years, which we've had over the last 10 years. This is the start of another cycle. And it's not at the bottom of the cycle, but it is the start of another cycle, and that is a great time to invest because you get a natural rising tide lifts all ships. So I think that's another reason to be. So there is money around, but it is perhaps in different places than it was before. And you'll see a lot of professional investors, seed funds, angel funds, big investors, even like EQT, who have a 700 million euro fund going much earlier and backing seed companies. And then the other reason perhaps to be optimistic is I do think that this will we'll bounce back out of this a little bit faster than perhaps the world thinks. I think the immunologists, the virologists I've talked to recently believe there's about 3 vaccines on their way that some of them could even start being deployed by the end of this year. And it's a pretty easy, actually, virus to kill compared to the common flu, colds, AIDS, and so on, HIV. So I think that gives a little bit more optimism. And then I guess lastly, just I think that the push to digitization, what you can do now online and create now has been so accelerated by this. The fact that we're all sitting here like this, the new tools that are available that you can build startups and get massive traction, customer acquisition, users and so on, totally remotely literally from your bedroom, because we are all sitting in our bedrooms right now, is quite incredible, and that's only accelerated. And investors are now working completely virtually and being forced to. So, you know, the idea of going to the networking event where you had to stand and pitch in front of a bunch of fusty old, white dudes from the city and pitch your wares as a young tech, startup out of Southampton are going to be dead, right? And that's only good, I think, because it means we can do this stuff and we can pitch online and you can get a wide variety of different people. And maybe the next one we can get a bunch of Southampton alumni from SF and from Paris and from Canada and Russia and everyone online pitching this, and you can raise money that way, new ways you never thought was possible. So I do think this is a tough time. I do think, though, that there will be some great companies formed, and I think if I would much rather be doing it at this stage than I would be 2 years ago, right at the end of a cycle, and or be a late stage startup now, which has big, amounts of money, and or the hospitality industry, yes, have been hit very hard, but I think those job figures mask the fact that a lot of these are gig economy and will bounce back as things start to open. But as you said, Max, not nearly to the level they were for quite a while. But look, I think, being an early stage one, it is the right time to be doing it. We can do a lot more, and doing it at university is the best time, right? So get out there, and hopefully in a year, as you raise your first money and come out, then the world will look a slightly better place, not the same as it was, but slightly better. And this push to digitization and will still be continuing, and there'll be new ways in which we can build new startups that we never thought were possible today.
The only thing I'll add to all of this, because I agree with the sentiment, is that if you're pitching for your new business now to angels, because if it's very early stage, it's probably angels rather than VCs that want to see a bit of revenue. So this is pre-revenue. You will have to have a slide in there to say, how am I dealing with COVID?
Yeah.
How is that impacting my business? And I think what it all comes down to then is your cash and your runway, because you're raising money now. You need to know you need to understand, coming back to that target audience, you need to know your customer, how the macro environment is likely to impact your customer, and therefore the speed to actually revenue, and then and then therefore how much cash do you need, what's your burn rate, how can you keep that as low as possible during this uncertain time, because what you don't want is in 12 months no real traction, need to raise more money at possibly a lower valuation. So again, this is where that question between when to take equity, when to bootstrap, I would actually encourage people to bootstrap as long as they can until there's a clear path to profitability or path to revenue if it's before profitability.
And certainly I resonate with that idea that certainly the people coming through the university where they have got an opportunity maybe to bootstrap for longer, they've maybe not got overheads they haven't raised yet, so they haven't got a big burn rate that they're having to worry about at the moment, have got the opportunity to try and build that validation now while things are bearish, while people don't have pockets that they're investing in. But what I'm seeing is the likes of Deloitte that then cancelled their summer internship for all of the graduates that they would have had coming through. And I think more and more of those corporates that are then pulling back are then making more of the young aspiring founders look at their options and saying, well, actually the certainty of the large corporate career is not as certain as it used to be. Maybe there's more potential and more to offer by taking it on myself and taking responsibility and trying to do my own startup, and seeing that as one of the fuels for innovation coming through, that as you see those people trying to do something different, that they can respond to the new reality more quickly because they're not encumbered by a previous business model that they're trying to pivot from or adapt from. They're just starting with a blank canvas and starting from new. And I wonder if that's where we will see some of that innovation coming through over the next few years. Look, I'm really conscious of time. We're going to have to wrap up fairly quickly. We had a few questions from founders. I think we've covered a lot of those questions, but it'd be really helpful just as a kind of a wrap up, if I could just go round the room and just ask for one key bit of advice that you would give to someone, maybe an aspiring founder or a founder right at the start of their journey. What would be one key bit of advice that you'd give to each of them? So Sonja, I've got eye contact with you, so I'll ask you first and then I'll go around from there.
I might have two things. Sorry, Ben. One is don't lose the focus on your client or your customer. And the second one is keep full tabs on your cash balance at all times.
Great. Max?
I think I would say if it's burning inside you, let it burn bright and do it. But go in with your eyes open. But if they are, and you need still to do it, then though you are a proper founder, go ahead and do it.
Yeah, that's great. Right. I love that. But I'm going to steal that, Max, unashamedly, if that's okay. That's awesome. I mean, that's another thing. Be brave, right? We are in tough times, and there's no doubt about it, right? Depending on how optimistic, this is obviously, a tough time, toughest time we've seen in a decade. But be brave. I mean, just to correct one thing, I'd say, we VCs. And I'm a founder. I still think of myself as a founder. It's hard for me to say I'm VC, but we invest in companies even up to Series B that have no revenue, right? What we look for is a huge idea with an incredible founder that has built something that they're proving the world wants and people want to use, right? And solving a very hard, probably technical challenge or a big consumer need, and just be brave if you have that. But eyes bright, I love it. Go for it and be brave and build that thing. that you think the world wants and will be a better place for it, and good things will happen from there. Whether it's not this startup or your next one or the one after that, great things will happen and the world will be a much better place for it.
Fantastic. All of you, thank you so much for giving your time this evening to share all of that advice and the experience. It seems like there's a few key messages that have come through. Firstly, it's going to be tough. It's going to be hard. Things are difficult. There's lots of prevailing winds. But if you've got something, if you've got that drive and the determination, you've got that focus on something really clear and a real focus on who that customer is and how you can make it work, then there's no reason why you can't make that a success. Thank you so much, all of you. Good night.
Thanks a lot, guys.
Thank you.